All right. Welcome, everybody. I'm Matt Garrett. The Federal Reserve has issued some new stimulus as of late Thursday night, that is important to a number of businesses out there. And so we wanted to make sure to get the information out to you as quickly as possible and make sure that you had all the information that you needed on it. And also not just information about what it is, but actually how to go about taking advantage of it, what you need to do in this case. So again, I'm Matt Garrett. I'm the founder, CEO of TGG, and we're going to go ahead and get started on this thing and talk about today what it is that that we need to do to make sure that you take advantage of every possible option that the government's giving us in these challenging times. So the first thing that we need to understand here is just a quick recap, and I know this is not anything that's necessarily new news, but worldwide health problems equals a worldwide global economic problems. And what we're seeing is, again, the stopping of this economy is really causing some massive problems all around the world. And so unlike unlike our Congress, which seemed to need to take a vacation before they passed a supplemental stimulus bill on Friday, we've been working all weekend to try to figure this stuff out for you guys. But just like Congress, I'm going to be very short and sweet with this thing and get you the information you need and get you out of here. So we're going to be about 15 or 20 minutes, and then we'll get you out of here. Look, what we have here is unprecedented unemployment. This was through March 28th. As you guys know, through last week, we were up to nearly 20 million unemployed people that have come out in the last 4 weeks. And that is the reason why the Fed has done this, because when Congress failed to act, the Fed stepped in and said, sorry, this is a really big problem. We need to put this thing out. And so what they did is they put something out called the Main Street Lending Program. And that's what we're talking about today, the Main Street Lending Program. Now, why did they do this? They did this because very quickly what you found is the funds that were in this PPP program were evaporating. And in fact, as of this morning, I checked, the latest figures are 220 billion of the 350 billion has already been spent and used in this PPP program in less than a week. So why the Fed felt the need to do this is to be able to inject more stimulus and more money into the system. This is a system that is, again, we're going to talk about this, but it's something that is completely separate from the PPP program. And it's for all loans greater than $1 million. So this is for what I'll call small and mid-sized businesses. It's generally not going to be for sole proprietors, generally not going to be for 1099s, that sort of thing. And it doesn't go through the SBA. So this is actually a benefit because the SBA obviously is clogged up with all these PPP loans. And I expect the Mnuchin and the Congress will eventually come around and put more funding into PPP. But again, this is a benefit that it doesn't go through the PPP, and it's in addition to it. So you can participate in this paycheck protection loan as well as go out and participate in this Main Street new loan as well. It does go through your bank, and this is a good thing for most bankers. I've talked to several bankers about this in the last couple of days, and what the bankers are frustrated with the PPP is they really don't make much money off of it. And so they're doing tons of work, working around the clock to help people out, but they're really not making any money at it. The nice thing about these Main Street loans is it gives the banks an opportunity to make some money. They're 95% guaranteed by the federal government, which means the banks are only on the hook for 5% of it. In addition to that, the federal government has given a 1% origination fee, so they're going to get a fee on it, and then set the interest rates between 2.75% and 4%. So there's still a big enough spread, so the banks can actually make quite a bit of money on these things. So let's talk about kind of what this is and what this means maybe to you. First of all, the loan features. The loans are between $1 and $25 million loans, and they can be used for anything. So this is great news because there's no forgiveness. These are true loans. It's not like, again, the paycheck protection loan or the tax credits or any of the other things that the government has put out there yet that are truly at least proportionately or somewhat of them being forgivable. These are non-forgivable. These are loans. They're real loans, but it's cash. So you all ought to think about this stuff, because what we want to think about is that you can use this Main Street lending program as well as the PPP or any of the other tax credits, and they go together. You don't need one or the other. And again, right now, we need to think about injecting as much liquidity into your businesses as possible, so that you can get through this and again, be it through it with good, profitable business decisions. Let's talk about what the loan looks like, because it is a loan, you have to be mindful of what's going on. It's a 4-year loan. So this is something that you need to be aware of, because again, if you're going to pay a loan off in 4 years, you need to make twice as much money for every dollar you spend paying off a loan. If you make $2, a dollar goes to tax, the other dollar can get spent paying down the loan principal. Great news here on this is that for 1 year, you have an amortization of the principal and interest that is actually deferred. So again, good news here is you don't have to make a payment for a year. There's a big question mark in this, and something that they haven't clarified yet is, does that mean that principal and interest are accruing or not? I can't really tell from this yet. We're going to get back to you with more information on this, but there is a good chance that this will give you a 1 year, essentially a free look. So if you get the loan, you'll get a year of a free look period to actually figure out whether or not you're going to use it. And if you don't use it, you just pay it back without paying any interest. So that could be a really attractive component of this loan. Right now, that's a little unclear, but that's the way we're reading it as of today. There's also no prepayment penalty. So if you want to pay it back at any time, you don't have any issues, anything like that. Let's talk a little bit real quickly about how this loan works and what some of the other sort of constraints on the loan are. First constraint that you need to understand is that the loan amount is a maximum. You have to have at least 4 times your EBITDA in debt coverage. What that means is the total debt to EBITDA can't be more than 4 times. So in this particular case, if you had $500,000 of EBITDA in 2019, by the way, that's the measuring year, you can multiply that by 4 and your potential loan amount is $2 million. Now it can be greater than that, but it can't be any less than that. Actually, it can't be any greater than that. It can be less than that. You have to have that amount in coverage. So what other loans might you have out there? Because it's total debt outstanding. Well, you might have an existing term loan of $100,000. You might have a line of credit for $200,000. Maybe you've got additional outstanding debt of another $50,000 to bring you to a total debt of $350,000. Well, then you're going to reduce that potential loan amount from $2 million by $350,000 to get your Main Street loan amount of $1,650,000. And that's how much you can actually go out and borrow. So these are the ways to think about this stuff when you're going into to think about getting these loans. Some basic eligibility requirements. Again, these are small to mid-sized businesses. You can't have more than 10,000 employees, and you have to be revenues less than $2.5 billion. I understand, because I'm in the small business community, this doesn't seem like small business. It seems like big business. But what the government is going to do here is trying to make sure that you use this money for the right reasons, and for keeping people employed is what they believe are the right reasons. So there are a lot of constraints around these loans. What are the constraints? First constraint, you cannot refinance other debt with these proceeds. You can't take old debt like your lines of credit, your term loans, and pay those off using these loans proceeds. Very important to consider. In addition, you're not actually allowed to take this stuff and just use it for anything. You actually have to say that this loan was required because of something going on with the coronavirus pandemic. So there's a portion of this loan packet that you're going to need to fill out that says why the coronavirus has impacted your business, what it's done, and what you're going to use it for. Because the other key constraint is that you as a borrower, you have to make reasonable efforts to maintain payroll and retain employees during that term of the loan, which is the 4-year term. So you really want to keep thinking that the government is, again, trying to make sure people are staying employed. And that's one of the biggest focuses of why they're doing this. Now, the biggest potential drawback, and this is a real one, is that many business owners live off of their distributions and the distributions that come out of their business every year. This loan strictly prohibits any distributions or any dividends during the loan term and for 12 months after the payoff of the term. So that's the rule. That said, there are lots of workarounds in this. If you were a business owner and you need this loan to survive and you were taking distributions, it may be time to switch your distributions to payroll. Now you're going to pay a little bit more in payroll taxes in order to accomplish that, but now you've got a loan that can help you survive. So there are a lot of different potential workarounds. That's just one of them. You can also use guaranteed payments if you're in an LLC. You could increase bonuses. There's lots of ways that you can take money out of your business. So don't think that this is going to constrain you entirely. You can also loan yourself, frankly, money. And then after the period is over, you can turn around and distribute that loan out to yourself, once again, covering this. So there are a few different ways to get around it, but is the single biggest drawback of this bill is that there are no distributions or dividends allowed during the term and up to 12 months after the payoff. Okay, So that's your loan. That's what you need to think about. That's this Main Street loan. That's the new thing that came out with the Fed last Thursday night. And the Fed did it again because Congress is failing to act and fill up more stimulus. So how do we take advantage of this? We created over the weekend, really want to thank again my team, Robert Phillip, Ron Woody, Bonnie, Ryan Larson, Ashley Swanson, Janine Smith, I'm sure I'm forgetting somebody, Robert Rodriguez, and others. We worked over the weekend to get this organizer set up because this is different than the PPP CARES Act organizer. In this particular one, you've got to put different information in. So we've put it all together here for you in an organizer that's going to end up looking like this. You're going to have a nice cover sheet. And this is actually a loan that you can go into your existing bank, like you had to do with the PPP. That was a bank thing. They sort of forced people to do that. Or you can start competing it with other banks. Because there is a variable interest rate, you probably want to go to at least 2 banks for this thing so that you've got a good chance at getting the best rate possible. And again, using the organizer, you'll be able to do that and take one file to the bank and say, here you go, underwrite this, and let me know if I qualify. This is, again, what the organizer is going to look like. So let me talk a little bit about the TGG sort of stuff and how you can use this for us. If you're a brand new user, meaning you didn't use our PPP organizer, you can go to our website right now. And after this, if you've signed up for this webinar, we're going to send you a link. There's a do-it-yourself organizer. It is $500 for the first 50 people who sign up. And then $750 for everybody after that. And again, you're going to be dragging and dropping files into one thing so that when you give it to the bank, it's nice and clean and organized. And what we found with the PPP organizer that we did is we had people that were approved as early as a week ago and people who have already got funding under the PPP. So I'm going to tell you, I think this is the same thing. You want to get in line as fast as possible and take advantage of this to the extent that, that you're able. If you want to do it with a consultation with TGG, again, it's $1,500, and you can log in, and we will help you walk through this loan organizer. If you bought our existing PPP organizer, you don't actually go in and repurchase the Main Street package through our website. In order to be able to purchase the Main Street packet, you get a discounted price. The pricing for you is $250 for do-it-yourself packet or $1,000 for the consultative packet. So that's $500 off on each of those. And again, you go to your user center on our website, and there you'll see a link to purchase the Main Street packet. And if you have any questions, you can always email us at info@tgg-accounting.com or feel free to call us. And again, after purchase, you'll be able to see the Main Street package and walk right through it. Look, we're excited to be able to help you all through this thing. And I do believe that this, if you qualify, is one of the best. Again, the government is just putting a ton of work into stimulus, and they need to. We are in a terrible spot. Regardless of what the stock market is showing us right now, I think we're going to see a lot more unemployment. We're going to see anywhere from 20 to 50 million people unemployed by the end of this thing. But we're here to help. We have real actionable to-dos out of this thing, which is go ahead and fill out that organizer and start getting in line for these Main Street loans. What I want to do now is I'm going to take some questions and make sure that I get all your answers or answers to your questions. So I'm going to go into the chat here and start answering questions that you guys might have. Oh, in addition, I just want to make sure you know that in our chat room is a link to that organizer, that Main Street toolkit. So if you want to, if you go into the chat right now, you'll see it in there. All right, let's see. Harsha, maximum loan size that is lesser of 25 million or an amount that when added to the eligible borrower's existing outstanding and committed debt, but undrawn debt. Yeah, that's correct. The maximum loan size, again, you can't go more than total debts to EBITDA of 4x. From Ori, what is the interest on the loan? It depends on what the banks want to do. It's somewhere between 2.75 and 4%. But the banks really get to choose, which is why I said you want to really put a packet together and then go and price this out, because that's a full 1.25% difference on $1 million. That's $12,500 at least difference in interest rate on an annual basis. Let's see. Oh, Archie, you're saying meaning that if I have a line of credit that is not drawn and used, it has to be subtracted. Yes, it does. Any outstanding line of credit amount still has to be subtracted, even if it's not used. So again, this is where you're going to want to sort of work through this, and we're happy to help you because you really want to think through what you're going to be using the debt for. And maybe it's worth drawing down on your line of credit. Maybe it's worth lowering the line of credit, the unused portion. Maybe it's worth just going after the existing stuff that you've got, PPP and your line of credit, and this Main Street lending, but you really want to think through overall your cash flow strategy. All right, next one. Is there an owner guarantee requirement for these loans? No. This is one of the brilliant parts. It's, again, no personal guarantee and no personal underwriting, no credit checks, no background checks, none of that stuff. It is 95% guaranteed by the federal government. So the banks are taking very little risk in this, and so are feeling pretty darn good about it. Did you say the minimum loan size was $1 million? Yes, I did. So let's assume, John, that you had no debt at all. You have to have a minimum EBITDA of $250,000 to get $1 million. That's 4x, right? If you have no other debt. So at least $250,000 in EBITDA to make this thing work. Can we restate EBITDA with add backs? We look to be loss making through fast growth and could likely restate capitalizing development costs. So let me say yes and no. If you're doing it for tax purposes and you didn't get to an EBITDA of $250,000, but for GAAP purposes, you can actually claim $250,000 or more even in EBITDA. Absolutely. You have to follow the rules though. Be very careful. They're going to be looking out for fraud in this thing. And you never ever want to fudge or inflate your numbers just to get this loan. That will be a huge, huge red flag. So yes, if there are things that you're writing off for tax purposes, but then you could actually capitalize and depreciate, it's going to increase your EBITDA, then absolutely use those add backs and go and do that. Is there a minimum business age requirement? No, there isn't. You had to be in business again, same as the last one, as of February 15th. But other than that, no business age requirement. And in fact, you're going to have to have been in business most of 2019 to be able to qualify under the EBITDA requirements. That's just sort of a default, even though they didn't say that in there. John, yes, the minimum loan size is $1 million. Let's see. I attended another webinar on this topic, and they said the line of credit limit was to be considered in the debt, not just the line of credit balance. That's correct. It's the line of credit limit amount. So if you have, say, $1 million line of credit and you've only used $500,000, they'll take the full $1 million into account for this when they're thinking about your total debt. So that's correct. Margaret, we have no loans but need to pay existing vendors that we would have if we were open. That's great. You can use this money for that. That's exactly what it's supposed to be used for, is all operations. Contrast that with the PPP that had to be used and has to be used for payroll, 75% for payroll costs and 25% for occupancy costs in order for it to be forgiven. This you can use for anything, marketing, other vendors, all sorts of stuff. So that's good. Let's see. Are there options for pre-revenue startups that have raised significant capital? Unfortunately, Jonathan, this would not be an option for pre-revenue because you have to have that EBITDA to debt ratio. So it's not going to fit for everybody, but that's why we wanted to get this information out there, because there's a number of you that it will fit for. Are these recourse loans? No, they're non-recourse loans. So these, again, are non-personally guaranteed, non-recourse loans. Let's see, Trevor. If you wanted to utilize the free look time period, will you be out the 1% origination fee? Yes, that 1% origination fee is going to be, that's my guess. It doesn't specifically spell that out, but I would guess so. That would be pretty standard. Let's see. Matt, PPP has real constraints about maintaining employment and payroll. Does this program prohibit reductions as well? No, it doesn't prohibit any reductions. Again, they want you to use it, but they just say it as sort of like this nebulous, we want you to be using this to maintain payroll, and you'll do everything you can to maintain a reasonable level of payroll throughout the 4-year period. That's undefined. I'm assuming we're going to get some more clarification on that, but right now it does not prohibit any reductions. Mike, if I don't have the EBITDA to qualify for $1 million, do I have any other options? Yes. So again, going back to the earlier webinars that we did, you have the option of the PPP. Everybody should be trying to get that, that can. You've got this Main Street lending. You have a disaster loan that you can still look at if you need to, and you have an economic injury and recovery grants. Then you have state, local, and county-wide grants and other things that you might want to make sure you're taking a look at, and just being aware of all of those things. Because again, at this time, you need to try to make sure you can get all the cash in you can. Margaret, what does EBITDA stand for? Good question. I probably should have defined that. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So you take your earnings before you take all those other things out. So that's when we talk about add backs. You could take your earnings and add back interest, taxes, depreciation, and amortization. Jennifer says, if you receive PPP funds, does that need to be subtracted? No, Jennifer, that's the brilliant part of this, is it doesn't need to be subtracted. It's in addition to it, and it's separate. So that's great. Dennis asks, what period is the EBITDA calculation? It's for the year 2019, full year 2019 EBITDA. John, let's see. On the no distribution topic, we are an S Corp and taxes are paid by multiple owners. How do we get funds to the owners to pay their tax obligations if distributions are not allowed? This is a wonderful question and is the major constraint. You would in fact have to put them on payroll. And if you put them on payroll, you're not going to pay double tax. You're just going to pay a little more in payroll tax than you'd be paying existingly. So you're on the existing structure. So you're really going to want to think through what that looks like. Now, I could see in the future them coming up with a modification to this rule where you can do for pass-through shareholders, you can pass through enough to pay their taxes. But as of today, that is absolutely prohibited. And so it's important to be, prepared for that. All right, let's see. What if you have non-calendar year end in 2019? Do you have to compute your EBITDA on a calendar year basis? Again, a great question that's not specified. What I would tell you is go ahead and do it on your on your tax year. So if you're a C Corp or a nonprofit organization and you're filing on a non-calendar year basis, yes, do whatever you need to do to file on your regular basis, and I think that would probably apply. So I think fiscal year is, in most cases, fiscal and calendar are going to be the same for most people. But if you have a different fiscal year, calculate it on the 2019 fiscal year and use that as your tool. Now, if 2019 fiscal year is carrying over into this year, you want to make sure you may just want to annualize it and use your full year 2019. All right, what if we sell the company next year? How does this impact owner distribution restrictions? I would assume that if you sell the company next year, the first thing you're going to have to do is go in and make sure that you repay this loan. Now, again, there's no prepayment penalty. So really think about what it is that you're going to do with this business. And if you were going to sell it, you want to make sure, you want to make sure that you're paying off that loan before you sell it, so you're not violating any of the rules. All right, Manish, let's see. I understand it is 95% participation by the Fed, not 95% guaranteed. Said another way, the lender retains 5% of the loan and 5% of the risks. I think that's 100% true. I would tell you 95% participation by the Fed, 95% guarantee is the same thing practically for that exact reason. The bank is retaining 5% of the risk and all of the other risk goes to the Fed. All right, Lee, what if you have a private investor loan that subordinates to all of the debt? Do you need to include that loan in the formula? You do. It's total debt. It's total debt outstanding. So if you have another loan outstanding, that is going to be a part of it. Sometimes what people have done is their CPAs have had them take shareholder loans, right? Or the shareholders have provided debt to the firm. If that's the case, you may want to think about, if you're the sole shareholder, removing that debt from the equation so that you can get a bigger loan amount. And there's ways to get that done. All right, let's see. From Brad, does the PPP and the EIDL, which is the disaster loan, have similar restrictions on distributions? No, it doesn't at the moment. Okay, let's see here. More questions. John asks, can we use this loan to pay off existing loans? No, we talked about that. Anonymous, we talked about if you have a line of credit of $1 million, but you're only borrowing 300, the $1 million is what counts against your total debt. So again, you really want to organize your debt in a way that you've got this PPP money coming in. You may have disaster loan money coming in. You may have grants coming in, and then you may have this Main Street loan. And you might want to think about your equity line of credit, your other term loans, and what can you do to get the cheapest debt possible for your organization and make sure that it cash flows correctly. And that's really looking at that scenario planning and that forecasting that we talked about in previous webinars. All right, let's see. What if we are a really small business and make only $200K a year and have no debt? Might we qualify? You're only going to qualify if you've got at least $250,000 of EBITDA per year. So that unfortunately means that many real small businesses are not going to qualify for this. All right, how does this program differ, especially as it relates to affiliates, from the current program? This is a big positive. So if you're venture-backed or private equity owned, anything like that, it doesn't matter as long as in total they don't have more than 10,000 employees or do more than $2.5 billion in revenue. So the great news here is that you can qualify if you're a venture-backed kind of firm or if you're a PE-backed firm. And so that is very different from the PPP. There's no ownership requirements. So if you've got common ownership, you don't have to worry about all that stuff. Those rules went away with this with this Main Street loan, and that's a big difference between that and the PPP. Let's see. Roseanne says, I'm starting a new business. I don't have EBITDA yet. Can I qualify? And unfortunately, no, Roseanne, that it doesn't apply to that. Let's see. Anonymous, are you automatically disqualified if your EBITDA for 2019 is less than 250, as in 250 times 4 equals $1 million, which is the minimum loan amount? Yes, unfortunately, that is the case. So there is a much smaller scope. It's really not supporting small businesses. It's really what I would consider to be mid-sized businesses. Let's see. Anna says, hi, can we get this loan and the first SBA loan, EIDL, the disaster loan that came out? Yes, you can get both of those at the same time. James says, can you lend business money from the proceeds? Meaning, can you buy a company that has similar ownership as the company receiving the loan? So what this is restricted from doing is any shareholder buybacks, any distributions, any payments to shareholders. So I would be really careful in this situation. Any kind of money that you lend out of this, you want to make sure that you're lending on an arm's length basis. So that would be, to me, something you'd really want to work with your internal accounting department on, your attorney and your tax CPA to make sure that you were following the rules on this. Because although it looks like from a pure letter of the law you could do that, I would be hesitant to do that just because of the optics. And if you were self-dealing, it would be a problem. If you were doing it on an arm's length basis, it's probably okay. All right, Rob, how is this different than the SBA disaster loan fundamentally? Okay, Rob, this is fundamentally different because the SBA disaster loan requires you not to be able to get credit from other places. So if you can't get credit anywhere else, then you can get the disaster loan. The disaster loan is also really strictly for the disaster component of it, and up to $2 million, where these loans can get much bigger than that. So you've got different options here, and again, they should be taken into consideration. Tim Lawson, is this loan reduced by the PPP loan balance as well? To the extent that you have an unforgiven portion of the PPP loan balance, I would say yes, because that would add to your total debt. But right off the bat, I would say no, because most of this is on the PPP is supposed to be forgivable if you're using it for the right reasons. What about, Krista says, what about available credit on credit cards too? Do we deduct this amount as well? This is a great question, and it's unclear. What we are doing as a firm, what TGG's position is today, is that total debt outstanding is debt to institutions. So term loans, vehicle loans, leases that are capital leases, and lines of credit, things like that. That's what we're taking to be total debt, not things like accounts payable or employee benefits payable or payroll costs, payroll liabilities, things like that, or deposit liabilities. Those are liabilities, but not really loans. And so we're taking them to mean true loans as the debt outstanding. Robert asks, can this loan be used for machinery? Absolutely. This is the brilliant part of this loan, is that you can use it for just about anything. So that's great news. Bonnie asks, can business owners take guaranteed payments? Yes. Guaranteed payments are still allowed under this. Guaranteed payments are essentially salaries for people who are owners and active participants in an LLC. And it appears that that still is acceptable. John, does it current SBA, not PPP loan, need to be factored in? Yes, it factors into total debt, but it doesn't preclude you or exclude you from participating in this Main Street program. All right, Tanya says, in the PPP loan, there's an issue with affiliates. Does that apply for this? And Tanya, that's what I was saying before. No, it doesn't. So that's good news there. All right, let's see. Marks, thanks for this. So based on EBITDA requirement, a pre-revenue startup, no matter how well qualified otherwise, cannot qualify. That is correct. Christina says, any restriction on the use of money? Answer there is no. You really can use it other than the restrictions that I talked about. No shareholder buybacks. You can't refinance existing debt, meaning you can't pay off existing debt. But other than that, you can use it for all operating expenses, including payroll, but not limited to payroll, including things like occupancy, but not limited to that. So you can use it for marketing. You can use it for IT spend. You can use it for machinery. All that sort of stuff is qualified. Will qualify for this. Is accounts payable taken into consideration as well? Again, we're taking the position, and I believe this is where it's going to come out, that things like accounts payable or payroll liabilities or even deposit liabilities or deferred revenue are all not loans under this that would qualify as total debt. It's a liability, but they don't have interest rates associated with them or payoff terms or anything like that. So that's kind of where we're drawing the line in the sand. All right, let's see. Are you restricted if you are in the cannabis industry? So this is another interesting one. This doesn't specifically call out the requirement that you are a federally legal business. So as of today, I would suggest that you might qualify. I think this may be a loophole that they close pretty quickly, but at least today, it doesn't specifically call out that you have to be a federally legal business. So that may be on purpose, that may not have been on purpose. Not quite sure, waiting to see some guidance on that, but at least now the cannabis industry should be able to apply for this. All right, Krista asks, also, are we looking at deducting total debt as of 12/31/2019 or total debt as of today? And I would tell you it's total debt as of the date of application. So as of today, not as of 2019. Norman asks, can attorneys and CPAs that package this for their clients be paid by the bank like in the PPP? There are no restrictions for payments from a bank to you in this particular loan program. In the PPP, they had specific guidelines through the SBA, because they were really SBA guidelines, on how CPAs and attorneys could get paid for helping to package these loans up. There's no guidelines in this particular one on that, and so it's unclear. But I would assume that yes, you'd be able to get paid if you are helping and you're a CPA or you're an attorney helping package these up for the bankers. But I would assume it also would go through the bank, not through the SBA like the PPP packages. All right, let's see here. Let me see if there's anything else that I've got in there. I think we are just about done for time. All right, well, let's see. Got a couple of other questions. I'll do these really quickly. Greg, do seller notes count as debt? If they're seller notes that are owed by the business to a seller, then yes, they would count as debt. What if we haven't heard on our PPP? How would you approach going after this money? So this is a great question. Stephen asked, what if you haven't heard on our PPP? How would you approach going after this money? These are two separate things. I would do them in separate tracks. I would 100% go after the PPP money and hope you get that. And I would 100% go after this Main Street loan if you can qualify. The worst case is you get approved for both, and then you have to decide, do I really want the Main Street money? Because the PPP obviously is forgivable. So you definitely want to go after both in this particular case. All right, let's see. We have existing debt. This is Margaret. We have existing debt as vendor merchandise owed. Would that have been paid? That would have been paid in April. Is that okay for this loan? Let's see. Existing debt as vendor merchandise owed. I'm guessing that's sort of like on consignment. It's a little unclear for me as to exactly what the question is, but I would say that vendor payables, again, are not going to qualify as outstanding debt for the calculation on how much you can get in this loan. Evan asks, will this webinar be sent to us as a link? Yes. All registered attendees are going to get an email here this evening after we upload all of this to YouTube and everywhere else. Facebook, LinkedIn, all those places where you can find this. And we'll send you a link to this webinar as well as a link to our organizer. Dennis just sent out a calculation that looks to be correct. Yeah, so there's a lot. It's not super hard to calculate how much you can get on this thing, but you really want to be careful. Make sure you follow the rules. Make sure you're not fudging for it. The government is doing its best, frustratingly, but doing its best to try to get everybody to survive this through these loans and through the PPP and other things. And so, again, focus in on what you need to do for your business. The last thing I want to leave you with here is the thought around what it takes to really be successful is not these loans. Okay, what we have here is an opportunity to really do some amazing work on our own businesses, really fine tune things, really get into accountability, really make sure that the money you're spending on things is effective and efficient, and work towards break even at least and profitability. And the more you work towards that, this is just another way to help bridge that gap and get that cash that you need to get to that gap. But please do not look at any of these loan opportunities, whether it's the PPP, the disaster loans, the economic injury grants, whether it's this Main Street funding loan program. Make sure that what you're doing with your business is focusing on the long-term viability and profitability of your organization. Take this opportunity to bring in new technology, to do new things that you might have, not necessarily needed to do in the past, but now are going to make you that much more efficient and effective moving forward. If any of us at TGG, myself included, can help you, our contact information is here, info@tgg-accounting.com. You've got our phone number, and then the organizer link there as well, which I know has been put into the chat bio as well. So I want to thank everybody for joining today. Thank you for participating, and thank you for supporting our small business community. We really appreciate it.